Good morning. This is Ed Broshinsky with your MarketSense morning commentary for October 5th. Grains are dipping into the red this morning after upside momentum began to fade towards the end of yesterday's trading session. The overall market had been pricing in hopes of a Fed pivot towards easier monetary policy and lower interest rates to avoid a global financial crisis. The US dollar weakened yesterday, the stock market rallied, and commodities strengthened on the optimistic start to the week, but uncertainty is creeping back into the trade sentiment this morning. Inflation has not been beaten yet, and hopes for a pivot to easier monetary policy may be premature considering a rebound in energy prices in recent days, and sticky food price inflation is still dominating the inflationary environment. The US dollar is a barometer of overall market sentiment. Fearful investors buy the US dollar as a safe haven for their capital, while optimistic investors sell the dollar and moved towards riskier assets like the stock market or commodities. Yesterday, the US dollar moved sharply lower to trendline support, but this morning now the dollar is rallying again, suggesting that there is some unease among market participants. An OPEC meeting today will dominate commodity market sentiment. OPEC Plus, which includes Russia, is clashing with the United States as Saudi Arabia is accusing the U.S. government of market manipulation due to their strategic petroleum reserve releases. And Russia, of course, claims it is at war with the collective West. Rumors are circulating that the Russians and Saudis together will cut production by 2 million barrels per day. Such rumors lifted crude oil prices to 3-week highs at $86.70 a barrel, pushing past trendline resistance. Markets are concerned that high energy prices will continue to boost inflation and therefore lead to further interest rate hikes, stifling growth, and causing a recession. The rally in energy prices has a mixed influence on grains and oilseeds. On one hand, higher oil prices tend to support biodiesel and ethanol prices, and that should support veg oils and corn grind. On the other hand, energy-led inflation could lead to recession, and it would be a net negative for demand. This morning, the market is turning its attention towards the latter, demand uncertainty. Canola may be one of the more equally distributed markets in terms of energy and human consumption demand bases. European rapeseed, for example, is used almost exclusively for biodiesel, while Canadian canola is used primarily as food. Canola rallied sharply yesterday as energy prices spiked and short speculators in the market were forced to buy out of positions. Declining open interest in recent days in canola is evidence of short covering in canola as speculators are forced to cancel out their positions. Open interest falls, but prices rise. Now, short covering rallies are notoriously short-lived, however, and a late session reversal in canola market yesterday might have marked a top in the market for the time being. Cash prices for canola in some geographies reached $20 a bushel. That's a key psychological number, and it led to increased farm selling. We are considering a 60% sales recommendation for canola if the market is unable to regain its momentum today. Veg oils also displayed a test of resistance and subsequent pullback similar to canola. Soybean oil tested trendline resistance at 65.5 cents per pound, and then it pulled back. If energy markets are going to be a driver of oilseed markets, then soybean oil will be the main commodity to watch, as it often trades in close correlation with energies. Soybeans are weakening this morning as well after a modest two-day rebound. Barges along the Mississippi River are reportedly running aground as low water levels are forcing barges to run at 75% capacity. Loss of 25% of river barge shipping capacity right at U.S. harvest is a major disruption in the United States, akin to shutting down one leg of the Trans-Canada Railway during peak shipping season. Barge freight rates have skyrocketed to the equivalent of $2.50 a bushel versus less than $1 a bushel just a few weeks ago. This is causing backlogs in the U.S. harvest that is hurting interior basis levels, but increasing Gulf Coast export prices. Wheat markets are not directly affected by the barge freight problems, but they do trade in correlation with corn, which is negatively affected by the transportation snarls. Corn is trading in a narrowing wedge consolidation pattern with a bias towards a downside breakout, considering seasonal harvest pressure and soft demand. After the USDA made large cuts to wheat production on Friday, the market has calmed as the demand side of the equation is calculated. The Black Sea export corridor is still open, and Russian and Ukraine continue to export grains. The sharp rise in U.S. wheat values on Friday did not help demand, and the USDA is expected to slash export forecasts in the upcoming October report. The wheat market may be in for some choppy sideways consolidation trading until there is a change in the Black Sea situation or a clearer picture of demand emerges. Kansas wheat has resistance at $10.11 a bushel, and Minneapolis wheat has resistance at $10.01 a bushel. Now, with all the volatility around commodities, financials, and currencies, the Canadian dollar has been caught in a storm. The loonie surged higher yesterday on the back of strong energy prices and the sell-off in the U.S. dollar. This morning, however, the strengthening U.S. currency is dominating the loonie, and strong energy prices aren't playing much of a role. The Canadian dollar is down this morning, 0.6 cents U.S. It trades at 73.4 cents U.S., up on the week, but down very heavily for the fall. That's all for the morning. This is Ed Broshinsky signing off for your MarketSense morning commentary.